Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you so much for watching the channel. Thank you for subscribing, and specifically thank you for the comments down below. It's been very informative, and I really appreciate the dialogue we're having on stocks. This channel is dedicated to rational investing, and what do I mean by that? It's the hunt for intrinsic value based on historical earnings and what we can accurately and with some confidence project into the future to figure out what the intrinsic value of a stock is. We then compare that to the current market price and look for the spread between the intrinsic value and the market price. That difference is our economic return that we expect to realize over time by holding the stock. Okay, today we're going to look at Wells Fargo. Wells Fargo is going to be part of a small bank series I'm going to do. The bank sector has been hit hard recently with the coronavirus and kind of possible write-downs or bankruptcies from retail sectors, as well as the lowering of interest rates, which reduces the net interest margin for banks, all of which has culminated into a rather sizable hit to the price per share. And let's see how that stacks up with the economic return based on what we think the intrinsic value of the stock is. Okay. In this channel, what we look for is five key attributes. One, it's top line revenue growth. Earnings growth would be the second one. We define earnings by EBITDA. Third is cash flow growth. Fourth is a strong balance sheet. And five is the well-priced stock. It must be well-priced for the return to happen. Otherwise, you're just paying too much for a good company. All right, when we look at the bank sector, we're going to have to change that up a little bit because the banks aren't a typical company. Typical company has raw material costs or service costs. You think of Ford Motor Company. They have steel, they have inputs to make a car. What's a bank's raw material? Right? It's cash, it's debt, it's financing, it's leverage. So how do you distinguish on the P&L cash from operating activity from cash used to provide the good to customer? It's exceedingly difficult, actually. So what we're going to do is we're going to change up our model. We're not going to look at EBITDA margins and EBITDA multiples. We're going to look at book value and book value growth rates and book value multiples. And then we're going to look at net income. We're going to look at a net income margin, and we're going to look at that. That's how we're going to value banks. And you want to find a bank with a solid earnings yield, in this case it'd be net income yield, and then a book value. Hopefully they're growing. Okay, let's dive into Wells Fargo and take a look at what we have. The first thing what you'll find behind me is roughly 10 years of financial information that I've pulled from their 10Ks. I highly recommend you print out and read the 10K. It's filled with amazing information. And here you're going to find the top line revenue is composed of two key elements. One, the net interest margin, and two, non-interest revenue. All right, let's take a look at this. Net interest margin, what does that mean? A bank takes in deposits. You deposit your paycheck into the bank. They then turn around and lend that cash out to someone else in the form of a loan, typically a mortgage, could be a business loan. The net interest margin is the spread between the money that they pay you for your deposit and the money they receive from a loan that they make. So as an example, if they make a mortgage to someone, let's say at 4%, they're paying the deposit person 1% for the money. They give that money for a loan at 4%. They're making a 3% net interest margin on that cash. Okay, other revenue would be non-interest revenue. That would be like banking fees, overdraft fees, consulting work. It'd be all the other charges and revenue that they can bring in that's not related to the spread of money. Okay, let's take a look at Wells Fargo. They started at $88 billion and they've come all the way to $103 billion. That's a lot, of revenue, but it's not a lot of growth. On average, that is 2.2% annual growth over that period of time. Net income is both positive and growing slightly, albeit this last year. On the long term, however, it's growing at 2.2%, which is in line with top line revenue growth. You then have the margin, the net income margin, right? Net income divided by revenue. It looks like it's strong double digits with high teens, low 20s is the net income margin. Per share, this is shares outstanding over the decade period of time. And what you're going to notice is that the shares have declined an average 2.3% annually. Now, this is very important. All right. So what here is going on is Wells Fargo is using free cash. They're buying shares in the public market and they're canceling them. That means that the shares outstanding, if you owned the share and they canceled other shares, your one share is now worth a greater percentage of the company. And it's a really big multiplier effect on your cash flow. It's also a tax-free way of providing gain to the investors, right? If you have net income that you've generated, you can dividend it out to shareholders, in which you pay a dividend tax on that, or you can buy back shares at the open price, which you pay no tax on. So it's one of the reasons that we look for a company that's got a high cash disposal that they're using to buy back shares. It's a great way to get economic return that is not taxed. All right, and until you sell the stock, but that's up to your discretion. You're not pushed to dividend and forced to take the tax. So here, they've declined the shares outstanding 2.3% on average over the years. Earnings per share has grown 4.6%. Now this is where you can see the effect of buying back shares. Net income is only growing at 2.2%. Then why is earnings per share growing at 4.6%? It's because they're shrinking the shares outstanding, and one share has more claim on earnings. Therefore, it's a compounding effect, right? It's 2 plus 2 is times 4, not 2 again. So really look for that. And that's also, conversely, if you look at growth stocks that are printing equity, they're expensing cash, it has the opposite effect if you're issuing shares. Be very mindful of that. All right, let's finish off this sheet. Share price outstanding at the end of the fiscal year was December. Earnings yield, I'm taking earnings per share divided by the per share price, and you'll see a nice earnings yield about 9.5% over the time frame, and that growth rate has grown. That earnings yield has grown. That's earnings itself. Earnings per share has grown at, call it, 5% on annual. All right, let's go look at book value. So a quick recap. What is book value and why is it important? But we can't look at the P&L, the EBITDA, because they don't have raw material costs like normal companies. We look at book value. Why? Book value for a bank is primarily financial assets, right? They're loans that they have issued or their investments that they have made. And those investments are marked to market annually. And it's a big difference from from like Ford Motor Company as an example, that would buy a factory and keep the factory on its books at the original purchase price. Here, banks are constantly reassessing the value of their assets and liabilities, marking them to market, and then any difference hitting the P&L and expensing it. So it's the P&L can be very volatile, much more volatile than a standard company, but the assets on the books and the balance sheet are much more in line with market value than, say, a big manufacturing company. So that's why we look at book value. Book value is defined by total assets minus goodwill and intangibles minus all liabilities. That's what you see here. I've got total assets, I've got goodwill and intangibles, and I've got total liabilities. I'm abbreviating total liabilities just with TL. So what's been going on, right? So total assets, $1.3 billion. That's actually all Jeff Bezos' money. Wells Fargo is one customer. It's a rare fact that you might know. Just kidding. That is 1.3 trillion, actually. I said billion, it's trillion. 1.9 trillion of assets minus the, is that trillion? Yes, that's trillion. Minus the goodwill and minus the total liability gives us a book value. So book value has grown over the decade beautifully, from $102 billion to $148 billion, 4.2%. That's a healthy clip. Revenue, remember, revenue is growing at 2.2%. They're actually growing book value faster than they're growing revenue, which is nice to see. All right, the next column over here, I've got book value per share, and then I've got book value per share growth rate. Now recall, they've been buying back and canceling shares. That means we would expect book value growth rate per share to be faster than book value itself. And lo and behold, it is 7.3% versus 4.2%. Why? Because if you have a share, your share is growing as a percentage of the business, and that's why this number is higher. Incidentally, that's why Warren Buffett never sells his shares, is he holds it for 50 years, and what he bought originally, his original ownership stake with the shares he has grown so much that he has no need. His dividends and his ownership is monstrous. All right, market cap. Shares outstanding times price gives you market cap. And over here, book value by price, or price by book value, excuse me. I'm taking price being the market cap, price per share times shares outstanding, divide by book value, and I get a ratio. That ratio is akin to the EBITDA multiple we would use in other classic businesses. Here at a bank, we're using a book value multiple because, again, the assets and liabilities are marked to market more frequently. They're a better indication of liquidity value, and we can use that as a benchmark for valuation. All right, so what you'll notice here is it's less than 2 times. It's between 1 and 2 times book value. If you look at today's price, roughly today's price of $24 a share, they're actually below. Sorry, I made a change and it's sitting here. There we go. That's better. 1.7 times. I had the stock price in early. I didn't update the sheet, but I have the historical price in here now. So now book value per share is 1.6 at the end of fiscal year. It's averaged 1.7 over the decade. What I had in there before was the current price of roughly $24, which means your price to book is below 1. It's 0.7. So that means you're buying the stock now, and forever you're buying it for 70 cents, and it's worth $1. That's going to impact our economic return. You're going to see that in a second, but I want to finish this first. So here we go. Book value per share, 1.7 times. Let's go look at net income, and let's forecast this forward, and then we'll see what book value looks like on a growth perspective. So we're going to pick up here at $148 billion of book value, and I'm going to grow that. Here we go. 148. I've assigned 0 growth for the next 2 years. Why? All right. Well, first thing about Wells Fargo was fined by the Fed for the bank scandal that they had in 2018. The Fed has capped Wells Fargo's assets as punishment for not quickly fixing the business because they were generating fake customers. So what that's done is it's capped the amount of assets to where they currently are. Recently, they've lifted that cap because of COVID-19. The loan program that they're trying to do is trying to get loans to small business holders. Wells Fargo is the largest small business lender in America, first or second. And in order to do that, the Fed has said, we're going to lift the cap and let you temporarily place this money in the critical hands of small business owners, and they've done that. But that cap is in effect. So I've assumed a couple years of capped book value, and then they're going to get back to a growth mode when the restrictions lifted. And so what I've done is I've picked up 2 years of doing nothing, and then I'm growing it at 4.2%, which is their historic book value growth rate. 4.2%. It's maybe 2.5 times inflation. It's not 20%. It's not doubling. It's not a hockey stick growth. It's very moderate. And I think, given that they've done this for the decade, they could do this for the next decade. I think it's very reasonable of a forecast. And what that does is it produces $345 billion of market value in 10 years. I'm basically taking the book value of slightly more than $200 billion in 10 years, multiplying it times the average price per book value, and I get a market price, a market cap of $345 billion. divide by the shares outstanding. I'm projecting a decrease in shares outstanding. Given that they've been buying back shares, they'll continue to do so. And so that puts a price target of just shy of $100 in 2029 for Wells Fargo. All right, let's go look at net income and see how that panned out. So net income is here, following the same logic. I've given zero value for the next couple years. One, they've got a lot of write-downs coming because some businesses are going to go bankrupt. Wells Fargo has extended these people credit. There's going to be some losses. I don't know how the magnitude, so I just said it's zero. Most likely it will be positive, but to be conservative, to build kind of a cushion or a moat, whatever you want to call it, I'm assuming zero. The other thing is Wells Fargo could possibly cut their dividend. They need to bolster the balance sheet. They need cash, certainly in these economic times. So I would be prepared for them to issue a reduction in the dividend. If they do, that could be a buying opportunity. I think people with short-term mindsets or people who only look at dividend yield as their single source of value are going to sell the stock, and they're going to sell the stock inappropriately. So look for that, but I'm assuming zeros for the next 2 years. I then take the average earnings for a decade of 3.9. They've been higher. So this average here is $3.90. Recently, it's been much higher than that. I'm not taking recently, I'm taking the average to be conservative. And I'm saying 390, and they're going to grow that at 4.6, which they've been growing historically. I get $5.35. I give that an average yield that they had before earnings yield, and I get $63. So we have two price targets now. We've got basically $100 and $63 as the two price targets for 2029 for Wells Fargo. What we're going to do, because we don't know which one to believe, we're going to average the two to come up with the average price, and we're going to compare that to the market price and come up with what our economic return is. So here we go. All right, current price is $24 roughly. I've got my $63.50 from the net income analysis that we did, and I've got the $99.40 from the book value. I'm averaging the two for $81.45 as a future value of the stock in 10 years. We plug that into our economic model, and what you'll see is a very healthy return, right? So we're going to start with $24 as our entrance price right here. Let me get you can see the top piece of it. $24 we're buying in. You've got zero cash flow for the first 2 years. I said there's zero net income. It should be most likely positive, but I'm just, for the sake of analysis, say it's zero. I'll pick up with $390. This is net income. It's not cash flow, right? Cash flow is very difficult to project. I'm using net income as a proxy. I then carry that out for another 8 years, and we sell the stock at $81.45 in 10 years. Here's the net cash flow with the inflow and outflow. You do an IRR of this cash flow, and you get a 24% annual return for 10 years. That is outstanding if this pans out, and it's certainly higher than the market. It's probably 2x the stock market over that same period of time. On a cash-on-cash basis, for you, those of you who like cash-on-cash, 4.9, call it 5%, 5 times cash-on-cash return. That is a very good return for one of the top companies in the S&P 500, one of the top companies in America, certainly one of the top banks, and it's you don't see this kind of often on companies that are massive like this unless the stock price has been hammered unjustly, and I believe that's where this stock is. It's been punished because they think that, or rather, there will be losses from the COVID fallout and bankruptcies. They could possibly cut the dividend, and they're capped assets for a short period of time. And I think there are investors that are very short-term minded that look for quarter to quarter, look for bounce, look for trading opportunities, and everybody has sold this. And as a result, if you step back with a value lens and say in 10 years, I want someplace that I can put my money that I know has a strong financial position, I'm buying less than book value, right? We covered you're buying at 0.7 times book value. What can I put my money in that has some protection that will grow? Still a stock, it's going to have volatility, fine. But if I don't need the money for 5 or 10 years and I want growth, this is a pretty decent shot. And that forecast of roughly 4% growth over time is certainly less aggressive than some of the tech companies out there with 20, 30, 100% growth curves. I mean, you got to smell check that and say, what's the probability you hit it? I think the probability here is pretty reasonable. That's why I bought it. Full disclosure, I do own it. So I'm front running just slightly, but that's okay. I don't have enough jack to move the market. So I like this. The last thing that I want to do is give you a spectrum of return. What can you expect at different pricing? So if we think that the long-term value here is $81 is the long-term price, 24 is roughly current trading price today, but that 24 is going to move around. And it could very possibly go south if they cut the dividend. Well, what does that do to our economic return? Here you go. Here is a distribution of returns at different pricing. So in the blue is the stock price that you could buy it at, hypothetically, right? We're currently roughly 24. If the stock were to decline to 22, to 20, and so forth, what is the IRR over the decade that you would get? And it's very attractive. As the price goes down, obviously the return goes up. So if it does fall based on the dividend cut, take that as a buying symbol. If it goes up to 32, you're still making 19% over the decade. It still beats the market, it's still very attractive. So I think in this range, there's a good margin of safety within the price. And if it dips, I'd definitely be looking at stocking up. All right. Final word here is good. So if I had to put a rating on Wells Fargo, I say it's good. Why? It's got a good balance sheet. We're buying less than book value at 0.7 times. It's got decent revenue growth, decent earnings growth, and most importantly, it is well priced. And I think that is driving this economic return. So I would give it a go. All right, my name is Cameron Stewart. I really hope you appreciate this episode. Thank you for watching Rational Investing. Please comment. Don't forget to hit the subscribe button. Thank you very much. See you next time. Bye-bye.